Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets, which he believes will be marginally higher over the short term. Ross examines gold, silver, crude, the U.S. and Canadian dollars, and Bitcoin. Editor of Rick's Picks, Rick Ackerman, joins us from Florida to dig deep into the silver space. He checks out Bitcoin and the direction AI is going. He also has some safe haven type trades. Veteran trader Victor Adair admits he's not much of a crystal ball gazer, but is keen on managing risk. He says even if crude prices stay the same or fall, oil companies are still very profitable. The editor of the trendletter.com, Martin Straith, warns the AI sector is sucking in huge amounts of cash with very little in the way of returns right now. He has a list of sectors he believes will do well in 2026. Martin also has a number of special offers for our listeners. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money, and Happy New Year.
Happy New Year to one and all. And, the last year had a lot of activity, especially in that last month of the year. So we have no idea what the surprises will be for 2026, but we'll just sit here with our charts and see how they unfold, and if we can get some good signals, then we will look to jump on them.
So the stock markets, how they kicked off the new year?
Kicking off the year, they started to attempted to rally right off the bat. The NASDAQ and S&P got off to a decent start. However, they are settling down from those levels, and we'll see what happens. But, as we've mentioned earlier, we're going through this rotation. So the strongest ones, the ones that maybe don't have the huge upside bias on a day-by-day basis, but are holding in well, are the Russell 2000, the mid caps, and if you take a look at the S&P unweighted, so you get rid of all those the 10 stocks or so that dominate. If you look at the unweighted index, it's been up to new highs in December, and has managed to hold those highs on a correction. So we are seeing something that's very, very similar to what we saw in 2000. And I think, a rolling top up here in the S&P 500 appears to be quite possible. Still looking for the good resistance up around 7,100 to 7,200. There's when it comes to looking at the credit side of the equation, we got signals on the S&P and that are quite negative about a month and a half ago. And typically what happens is you drop to the 20-week moving average. We did that. And then you get a bounce back towards resistance. And I look for the upper Bollinger Band, which usually is at a marginally higher high. And that's what we've seen in the last week or so. But a failure from there will set up for a pretty decent correction in these high flyers. So if you take a look at the Microsoft, Amazon, Meta, Netflix, and Apple, they really look as though they're tired. The only one that has got any good life in it right now is NVIDIA. So, I don't think the market can run on one stock, and the other names, the big names, seem to have run their course, and it's time for a big correction.
What's going on with gold and silver?
Last week and into the end of the year was some pretty exciting action. Silver got up there at all-time highs, up around $82, and then dropped like a stone. Got down to 71 and change. So percentage, not just dollar-wise, but percentage-wise, that's one of the biggest single 2 to 3 day actions that the silver market has seen in decades. At this point, if we look at it, the move, comparing previous highs and what's happened, this rally was a Fibonacci retracement above the old high, the 2011 high. If we project 1.618, so that's a Fibonacci number. If we project that above the high, then we got within $1 here recently on that 1.618 target. If you look back at the move in into 2011 or the move into 1974, both of those are similar. They did more than this. They did not just the 1.618, but they did 2 times the high. And so if the silver market wants to hold right here, I would say that the upside potential could be as much as $100, and then that would get close to some of the channel lines that we have in the silver market. If it runs out of steam, then when you look back at those previous highs, when you've had a 3-year run like this has had, ending up in a crescendo on the upside, the corrections have been 50% of the rally. So looking at the extent of this rally, the key support level will be back at about $59. So keep that one in mind. If silver starts to really give up ground here, and it's around 71 right now. If it can't hold this, then 59 becomes the key level to keep in mind. And that will be a tradable buy. There's no question about that. So let's see how the next couple of weeks unfold.
What's going on with crude oil?
Crude oil had a bounce towards decent resistance, but still is in its downtrend. Now, we were looking for it ideally to go down and create a December or January bottom. This one has got the makings now. I think that if we were to give up the ghost on the downside for a week or two, that could have set us up for a really nice tradable low. And look for, ideally looking for some kind of a bottom here in this next few weeks. So we'll be watching pretty closely. Signals are not there as of yet. And the best thing that we could do would be a dramatic move to the downside for, really, give up the ghost, maybe give up $5 or more very quickly. That would be the type of thing we'd want to see around a low.
What's happening with the U.S. and Canadian dollars?
U.S. dollar had decent downside move in the last 10 days or so, found some support, a little lower than we thought. We were hoping that it would hold just a small correction off that double bottom low that we had. So it gave up a bit more from its bounce, but seems to be holding in there reasonably well. There's a chance for a bit of an upside bias here, but it's we haven't got anything that would tell us it's time to jump on a trade. On the Canadian dollar, there was a good rally from that support level, and we're sitting at 73 right now, with resistance up around 74. At this point, the dollar has been strong relative to crude oil and the CRB, so that continues to be supportive for at least the short-term trend.
What's going on with Bitcoin?
Bitcoin, this is probably the most interesting one right now. We had the break during that hard move from 125 down to 80,000, and at the last few days of that, we got what we call a not just a downside capitulation, but the exhaustion index went into way oversold territory, something we've seen maybe 10 times or so since 2014. And each one of those gets the good bounce like we've seen. In this case, it was up to 95,000, then came back down to retest the low. We've done that at 85,000, and it's consolidated. And this consolidation, if it can come to life right now, we're looking at two short-term moving averages, and if they cross to the positive side, and they're on the verge of doing that today, I would suggest by midweek next week, if Bitcoin holds above 90,000, that will be a good-looking base, and there's a potential for a pretty decent rally on the upside. So, as I say, right now, watch 90,000 as we move into the early part of next week. That'll be enough to cause the bullish crossover in the moving averages, and there's some pretty good potential. So it's not just in, Bitcoin, but those who aren't trading Bitcoin itself, the GBTC, which is exchange traded, is a good, viable product.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Rick Ackerman, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Today, he's speaking to us from...
It would be sunny Florida, a little cooler than usual down here, Jim, but it's pleasant. I was playing golf yesterday. The temperature was in the mid-60s, and that's certainly not why vacationers come down here for Christmas week. They're paying exorbitant rates to stay in hotels, and I guess some of them must have wanted to go to the beach, but it's a little cool for that, but I think really pleasant.
Rick, do you think we're witnessing a bull market in silver or a short squeeze?
Well, they're really they're the same thing, really. I mean, I've always maintained that virtually every rally of significance that's occurred in human history on any exchange was powered mostly by short covering. That's the only kind of buying that's urgent enough to push things to insane highs and to push things past previous peaks and supply zones and things like that. So that's how bull markets happen. The main mechanism is short covering. So you've got a great deal of short covering going on in bullion, and it's just kind of odd that Trump has. It couldn't happen without Trump's sanction. It's not like the U.S. Treasury Department does not play some role in these activities. So you can assume that the short squeeze in silver has Trump's blessing, and it's hurting some really big players, Citicorp and B of A among them. They have a short position in silver that just between the two of them that I think is something like 4.5 billion ounces. So they're not exactly enjoying the rally.
Do you think China's trying to corner the silver market?
No, China is, they're so smart about those things that they're just observers of things that they know are going to happen anyway. In the case of gold, they've always given just, I guess, implicit sanction to the idea that all Chinese citizens should buy all the gold and silver that they want, and without China taking, let's say, a political position on gold, they can be huge accumulators of bullion, just because the buying is getting done by individuals. So China really doesn't have to plot and plan. They just kind of see the big picture, and they're letting. They've got good board position, and they just let these things play out.
Silver's been having a very strong run since September this week. The COMEX raised the margin on silver futures contracts from $20,000 US to $32,500 US, up 62.5% within 1 week. Is this mechanism being used to cap and crush the price of silver like what happened in 2011 and 1980?
Yeah, not at all. Not at all. In 1980, the margins were really raised. You're talking about, I didn't even think it was that much, really, a $12,000 increase in the margin. That's not enough to crush the market at all. In 1980, the margins went so high on silver that there were just two players in the game. There was the Bunky Hunt and his brother, and in Eastman Kodak. And that's what caused silver prices to fall. There was virtually no speculative activity after that. So the increased margins have obviously dampened speculation, but they haven't killed it. But putting that aside, I'm just looking at the charts and trying to come up with targets. And this recent high in COMEX silver, when I put it on a weekly chart and I consider the chart from the standpoint of what is the very highest price I could have projected for silver on the weekly chart, the high back just after Christmas at what was the price? I think it was, let's call it 80. Wait a second here. $81 and change. That was it. So I'm at least open to the possibility that silver has made an important top.
Is paper silver designed to control the price of physical silver?
Yeah, we've talked about this many times, and it's not designed to so much control it as it is to exploit it. A lot of these bullion bankers, for one, the supply of paper bullion is theoretically infinite. It's just subject to whatever silly notions. The regulators don't really regulate much, but and so part of that non-regulation has allowed silver equivalents, paper equivalents for bullion to proliferate beyond reckoning. Nobody really knows how much of it is out there, but they're getting called to account lately with this short squeeze we were talking about. So the old market floor trader saying is, or maybe it didn't originate with floor traders, but he who sells something, what is it? It's something that isn't, has to pay his debts or go to prison. But of course, we don't have debtors' prisons, and all the shorting is done by guys out of Wharton School and Stanford Business School, and they do have official sanction to do it. So yeah, paper gold is just another carnival trick that has, I guess, broadened the leverage that can be achieved with gold and silver instruments.
Does the silver market likely work like this? Silver's accumulated over time by the boys leading a market shortage. Then the market prices run up on increasing demand. With strong demand and rising prices, the boys then sell their silver retail.
Oh, I don't know. I mean, I think we've over-talked silver here. But it's, you can see it's just a big game, and I think little guys can exploit it too, in a way that the big guys don't. There's no, at the level of trade desks and algorithmic players, there's no such thing as a directional play. Nobody's betting that silver is going to go higher or lower. I mean, I say that, and there are obviously big exceptions, like the whole repo market in these instruments, which has absolutely exploded. And that has to do with the risk management of this huge short position. But anyway, it's the little guy can gain some edge, really, with a directional bias, provided you've got a system that'll give you good trades.
Is the price of Bitcoin likely manipulated by Bitcoin paper futures?
No, I don't know about paper. It's hard enough. There is no real Bitcoin. Have you ever seen a Bitcoin? So effectively, everything in the cryptocurrency world is, let's call it paper. Paper's a good metaphor, but paper has more substance really than the market, than what actually gets traded in Bitcoin, which are digital zeros and ones. So the bigger, the more important fact about Bitcoin is that it's pure fraud. It started worth pennies really, and now you pay, well, at one point you would have paid as much as $126,000 for one Bitcoin, but there was never anything of real value backing the market, and eventually the banks didn't put any skin in the game really, but they got out there with this idea that it's a legitimate medium of exchange, and I guess they lent it some legitimacy. So the Bitcoin markets have been crazy since their inception, and they're sort of bad crazy lately because they've come down from 126,000 to a current. What is the price? I never have the right page up here on my screen. It's current 90,000, but it's been a bit lower than that. And it's just been screwing the pooch for the last few weeks. So yes, there's some, there's a lot of manipulation that puts things like Bitcoin in a range for as long as it's been in a range. There are outside, well, they're insiders really, but they're exploiting a trading range in Bitcoin.
Private equity can cause dislocations within the economy. Do you see any private equity dislocations that could be in for a day of reckoning?
Yeah, I think if anybody's got it, if you feel like private equity has crapped up a lot of things, they typically buy out. The example I saw recently was it's a lady's name. They're associated with fabric. Is it Joann's Fabrics?
Yeah.
Anyway, you take a store like that everybody loves. It's convenient. There are a couple others I can think of. Michael's Art Supply would be another. Hold Everything. The few stores that people actually go to shop, they don't do it on Amazon. Well, the private equity groups, they recognize the businesses that are truly doing business out there, and then those scumbags come in and they buy the business, and they basically leverage it out. They borrow a lot of money to do the deals, and they encumber these companies with sufficient debt to eventually bankrupt them, and then they sell off the parts. So if you've come over the years to despise private equity and all the things that it does, you can rest assured that they're going to get theirs in the coming housing collapse, because they went into not just buying houses to rent them out to people who cannot afford houses, but they actually built homes with the purpose of renting them, and they did it. I won't say, well, it was somewhere near the top of the market, and still worse was that they paid top dollar in that market, even in doing refurbishments that would allow them to take a house and sort of put it in shape to rent. They didn't care how much they spent. And I know this because a good buddy of mine from my trading floor days, was one of the buyers for one of these big companies. He said they had no real experience in real estate, but it was just a numbers game, and they sent him to Denver with a blank checkbook, and they just said, buy everything. And they didn't care how much they paid. And someday, this isn't even a prediction. It's not like a crystal ball thing. It's an absolute certainty that they're going to get obliterated in that game. You know, they eventually took more than 10% of the entire rental market is what they own. And even though they've pushed rents up for people who can't afford to buy homes, it's foreseeable that all the private equity firms are going to be desperate to find tenants who can pay the rent when the economy finally turns down, which of course will be simultaneous with a downturn in the stock market, a bear market. Again, not a prediction, but a certainty. The bear markets happen, and this one's just a little bit overdue.
Has mass migration caused dislocations in the job market for young people?
Well, I'm not sure what that means, actually. I don't know about mass migrations. There are states that are enjoying an influx because of tax policies. Everybody's moving to Tennessee, to Florida, to North Carolina, and you can see it. I mean, you just drive on the roads there. In North Carolina, Highway 26 is pretty busy with truck traffic, and it's so crowded now, and they're everywhere you look, they're widening the highways and this and that. So there have been migrations to places where the economy is better. Typically, that's in the Southwest. You look diagonally across the U.S. to the Northeast. That's where things are weakest, and just kind of, not ironically, it's just because the stupidity of blue states, the tax policies in places like Connecticut, Rhode Island, New York, they're hideous. So that's responsible for the migration, because favorable tax policy causes business startups, and so they're starting up in states that just don't tax so high. So that's the migration, but I don't think it's only tangentially connected to the job problems for young people. I think something like 25% of all college grads, in other words, degree holders, are unemployed right now, and that doesn't even take into account the number of them that are underemployed or having to work more than one job just to scrape by. And the scraping by has really kind of percolated up to the level of kids who are at, let's say, Ivy League schools or top schools. A buddy of mine has a son that fits in that category, and all his friends were over at my buddy's house, and these are all, you look at them and you think they're going to be life's winners. They all went to prep schools and Ivy League schools, but in reality, the discussion concerns like, guys, how are we even going to pay the rent to keep our apartments in San Francisco? Because a lot of the startup jobs where there used to be a very good path to the top are only paying 55, 60, 70 grand. And that does not pay the rent in San Francisco, or it does if you're living, you're sharing a place with 4 or 5. So the young have that problem, but it's much worse because you don't even know where the jobs are going to be. I can't think of too many white-collar jobs that, in theory, have not been preempted by the capabilities of AI already, and it's just a matter of time before there are no entry-level white-collar jobs because the machines are doing it all. So that's a problem. And even though I've worked as a headhunter at various times in my life, it was a job that was a bad penny that kept turning up when trading wasn't working for me. And so I had a pretty good sense as a recruiter of where the jobs were going, the areas where I should be recruiting. But these days, I don't even think I could advise someone which way to turn other than to go in the direction of the trades. If you can do plumbing and electrical and carpentry, even now you can write your own ticket. It's impossible to get people with those skills, and it's hard for the college crowd, including the thieves who promote college education, namely the college administrators who just parasites who live off, in large part inflation. But they still haven't gotten. I don't think they believe yet that college degrees are already obsolete, and that the real money will be in honest work.
Yes, for good paying jobs, are young people turning to the trades, or are they still headed off to college?
Well, there are fewer and fewer of them are headed off to college, and of course that trend is being accelerated because college. It's possible the price of a degree has finally peaked. The colleges are going to have to start responding to supply and demand, and I think it's predictable that Harvard and Yale are going to go the way of the Metropolitan Opera, and they'll be telecasting to the whole world so that they have a revenue stream from people who are getting their undergraduate degrees, Ivy League degrees, and degrees from some of your better schools. Well, they're going to open it up to the video world. So I think they're going to be more and more open to selling degrees online, and the price will be determined by the reputation of the college. So that's coming too, but it will be in response to downward pressure on college tuitions, because I think that game is over. Just that parents can't be suckered anymore into thinking that their little Johnny's going to be digging ditches if he doesn't have a college degree. So, and that's true in spades at the level of the Ivy Leagues, where your 4-year college education might cost you $200,000 to $300,000.
Is AI looking like a net job destroyer?
Yeah, we've talked about that, I think, in every conversation we've had over the last few months, and it is. It hasn't destroyed all the jobs yet, because there's some resistance. There's no way that an AI can't do better than a lawyer. A black box placed in a courtroom has in its tiny little quantum head the entire law library. It's got every case history, every precedent that's ever been. So it can really argue chapter and verse, and it just knows the law. And yeah, there's something to be said for a good, slick criminal lawyer who gets up there in a $4,000 suit and cajoles the jury. They're always going to be able to find work. But for so much of what goes on in a courtroom, the AI box can just do it better. That's certainly true in accounting. And, I think I mentioned I had my own trademark difficulties. Somebody actually took the name Hidden Pivots and trademarked it. And I managed to get it back because I've been using that term for 21 years and this and that. But I had to pay a lawyer $1,800 an hour just to do that. And when I look back at the paperwork, the letters that got exchanged between my guy and their guy, it's either boilerplate or it's just personal stuff that didn't even need to happen for me to prevail. So virtually everything that, and as I discovered in this legal action, the whole trademark office is kind of set up to obfuscate the process, to essentially there so that lawyers can make money guiding you through the process. But I think a machine could do it a lot better. So in that case, we're talking about taking some of the highest paid lawyers in the country, Washington, D.C. patent and trademark lawyers, and acknowledging that a machine can do everything they can do better. So it doesn't matter which white-collar profession you carry that idea into. It can be accounting, it can be engineering, it can be this, it can be that. The machines are already doing it better. And the human job losses, the human jobs are going to give way slowly, but the handwriting's on the wall. This is the first, destructive technology that's not going to create more jobs than it destroys. It's always worked that way for hundreds of years, but not this time.
President Trump is onshoring manufacturing. Are there positives and negatives to that move?
Yeah, we've talked about that too in each of our interviews recently. But the problem with reshoring is that it's, I think, good to speak even in theory about bringing American manufacturing back. But what you never hear Trump say, and then any of the bozos who write about these things, and what you never hear them say is that the factories, in any case, will need to be competitive with factories all over the world. And that's as much as saying that these reshored factories are going to operate with 3 employees. It's like you'll have a whole steel plant or an auto assembly plant where there're just a couple guys in a control room running the whole thing. So it's not it's not going to create jobs. It will, let's say, bring a flow of money into this country, since we'll be building things that we can sell to the rest of the world. But to do that competitively, really, you have to acknowledge as the first fact that there are not going to be any humans involved. There are relatively few of them compared to, let's say, a steel plant that might have gotten built in this country 50 years ago.
Have big pharma and a very expensive healthcare sector likely seen their heyday?
Yeah, because, they really just sort of feed off the fatted calf, and they're crooked enough, sleazy enough, and clever enough that they've sort of rigged the whole price system for pharmaceuticals. Trump came at that pretty hard, and he basically said, especially for certain drugs, you guys are only going to be able to charge X. And of course, Medicare and the supplemental, they have quite a bit of say as to how much we pay for drugs and healthcare. So Trump really, it was more than a shot across the bow. It was a shot right at the hull of the ship there. Mm-hmm. When I mentioned earlier, it's like, where do you send the kids for jobs? Well, it's like Willie Sutton said, you go where the money is. He robs banks because that's where the money is. And all the thieves out there who operate as big businesses, the money is in our healthcare system. The healthcare system is not only unreformed, it may be unreformable because there's so many beneficiaries like myself who are collecting in health benefits far more than we ever paid in, but just try to stop it. So healthcare is still the fatted calf, but when I think the companies that operate there and have stepped over that line that separates just naked, brazen, unacceptable greed from just, tolerable greed, it's been exposed, and so I think that there'll be, let's say, a little more downward pressure on the pharmaceuticals industry, but they're never going to go hungry.
Any predictions on what could be the hot sectors for the new year?
Yeah, healthcare. That's a tough one, because I think it's already, AI has more than peaked already. There's so many trillions that have been either invested in or pledged to AI that we're way beyond it's that ocean liner that needs 20 miles to turn around. So the AI thing, it's not over. It's got a lot of play left in it, but not for all the billionaires who have visions of becoming trillionaires. It'll happen maybe for Musk, but I can't see it happening even for, let's say, the number 2 guy, Sam Altman, if you want to consider him 2 or 1, or Larry Ellison, all the other players. There's just not enough to go around. And so as far as, there are times when you shouldn't be in the markets to you shouldn't be thinking about how can I make 10% on my money on my nest egg at times. There are times when you should think about protecting your nest egg or protecting what you've got. And I think we're there now. We're really in one of those periods where you shouldn't be thinking, well, what's going to be the hot idea for 2026? You need to secure your capital, which means putting in things that have been the unsexiest thing in the world would be bonds. And although I've been an advocate of Treasury paper for a long time, I have to say that the picture for bonds can only improve if we're going into a depression. And that's sort of a hard choice there. You look at it, and there's still room for bond prices to drop, meaning for yields to increase, like we needed an increase to exacerbate the debt deflation that's coming. But I think you got to think of safety, which means not just fixed income instruments, but also utility companies with a good dividend history, and even some other regulated players where they're at least assured of making a decent return by the regulators. So yeah, I wouldn't be looking for hot ideas in 2026. It's all about protecting your capital.
Rick, where can our followers or our listeners follow you and subscribe to Rick's Picks?
Well, if they, I'm glad you asked, Jim. If they go to rickackerman.com, there's a free trial tab up at the top they can click, and I think I think we're off in 30 days now, and the chat room has really been hot. There have been so many tradable ideas in there that you could make back even if the subscription was $20,000 a year, I think you could make that back. But there's, so anyway, rickackerman.com, and just take the free trial, come in the chat room, be sure to say hello, and just take a look, see what it can make you.
Rick, thank you so much for being on This Week in Money.
My pleasure, Jim. I appreciate the opportunity to.
And best of the new year.
And yes, Happy New Year. I hope it starts well for everybody and even ends well. But 2026 is certain to be an interesting year.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from Florida. Coming up, Victor Adair, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. He's speaking to us from Parksville on beautiful Vancouver Island. Welcome back to This Week in Money, and Happy New Year.
Well, thank you, Jim. It's always a pleasure to talk with you, and Happy New Year to you and your listeners.
As we are just beginning the new year, before we get into the individual markets, do you have any New Year's resolutions or predictions you'd like to share?
Well, I'm not big on predictions. You might remember a few times on your show I've said that I make my money trading from being a good risk manager rather than because I've got a great crystal ball. So in my lifetime, my history, I've usually been the guy on a trading desk somewhere, and those folks generally don't have a lot of time or patience for what we would call the strategists in the firm that are actually just marketing guys. But I tell you what, I have kind of a hunch. I just feel like we're probably going to go into way more than we imagined this year coming. I just feel as though it's going to be a bumpy year. Probably have some unpleasant surprises and maybe some, let's say it might be a little more than we're expecting. I guess that's just kind of my gut feeling at this moment, but we'll see. Maybe I'm just getting older and grumpier.
Silver had a spectacular rally from late November to the end of the year. What are your thoughts about silver?
Well, silver did have a truly spectacular rally. I think just to be a bit of a spoiler here, I think part of that rally, particularly the last couple of weeks of it, was goosed by what I would call over-leveraged speculators, people that are just piling into, any market that's going up. It could be any stock symbol or whatever. And in this case, it was for a lot of those folks, just the silver ETFs that they were trading. And that's not just in the United States. I mean, there was just massive plunging into silver in the Asian market, particularly in China. Some people are thinking or putting out there, that the COMEX exchange, part of the CME, is trying to, spoil the party by raising margin requirements. I was around and very actively trading silver and gold back in the very beginning of 1980, whatever that is, 6 years ago. And we raced silver up to $50 an ounce, and the exchange came in and did a rule change that said basically liquidation only for speculators. And the silver market fell $13 an ounce over one weekend. I think it was about the mid-weekend of January of 1980. And what the COMEX has done this time around, I think, is just to calm markets down a bit. And let me just go back to what I was saying at our opening. I'm keen on risk management. I think that's how you make money, as opposed to having a great crystal ball. And in my lifetime, I have seen a lot of people, a lot of traders lose a lot of money. And I'm going to say, whether it was people I knew or people I read about or knew of, almost every time it was people that were way over leveraged with their positioning. It's great when it's going your way, and when it goes the other way, it's awful. So I think they needed to raise the margin requirements. I know that there's a lot of things out there. China playing a bit of a rare earth card by saying they're going to limit the export of silver beginning of January. Certainly the debasement trade, as we've called it, which to me was in less sophisticated language, meant that if the government was going to not be able to balance the books and just sort of print more and more and more money, which would depreciate the purchasing power of the currency, then people would do what they needed to do to protect themselves from that. And certainly part of that protecting yourself was buying gold, then laterally silver and platinum. I think we've had a hell of a spike here. Now, I do not know, and this goes to that, I don't make predictions. I do not know if that high we had at the end of December is going to hold for some time, or, we're just having a brief correction and we're going to be, north of $100 from here. But I would say this, over some period of time, I don't know how long it takes. I know the refineries are backed up. If you have some scrap silver that you think, geez, I should trade this in now. Stuff's trading at $80 an ounce. When you go to wherever you go, they're going to maybe offer you $40 an ounce, because the pipeline between scrap silver and getting the refiners to get it into shape and in bars and out to other people is backed up. So, don't think you've hit a windfall here and you can get $80 an ounce for grandma's silver plate. I think that if we stay at $80 an ounce or thereabouts, that there's a hell of a lot of silver that's going to come out of the woodwork, and it's not just going to be scrap. I think some of the mining companies probably figure that as much as, they haven't done much hedging, because the shareholders want the risk passed through to them. That's why they're buying the mining company, is to take advantage of the run-up in precious metal prices. But for the guys, prudent guys in the driver's seat for the mining companies, I think they got to be looking at silver and at gold, by the way, at these prices, particularly with the options, the call options just trading at very high vol levels, that there has to be some hedging from the mining companies, the other producers. Anyway, my thing is here, we've had a hell of a run-up. I certainly wouldn't expect the prices to repeat the run-up we've had here as we go into 2026. Doesn't mean that the debasement trade is over or that people are going to stop buying it. But for me, it's just very tough to be either a buyer or a seller here because I just can't manage my risk. So because of the volatility is so wild. But people who've already got a position, like I'm saying, if you're sitting on a few 100 million ounces of silver in your mining operation, it would seem to me if you can afford the margin requirements, you're going to sell some forward and say we have to take advantage of this windfall.
Some analysts say the rallies in precious metals and copper resulted from the debasement trade. What is the debasement trade? Do you agree with that? And will that trade continue into the new year?
Given that I am a betting man, I would bet that yes, it does. I don't think it's over. And as I kind of crudely described, I think the debasement trade, or at least one aspect of it, is people trying to protect themselves from governments who are unable or unwilling, more likely, to try to live within their means and are debasing the currency. So you need protection. I don't see that changing. As a matter of fact, this is not a prediction. But I understand there's a high possibility that there's going to be midterm elections in the United States on the 3rd of November, which is 9 months from now. And when you look at the polls, I mean, Trump is not as popular as he used to be. Certainly the polls would tell you that he's not as popular as he thinks he is. And he may have folks around him that say, something, if we don't change a few things here, we run the risk of losing control of the House of Representatives and the Senate in the midterm elections. So here's what we should do. Now, what are they going to do? I think one of the things that is so front and center is what is called the affordability crisis. Right now, it appears that of all of the consumer spending that happens in the United States, 50% of it is done by the top 10%, where you register top 10 means in terms of wealth. And the other 50% is done by everybody else. So people that are prosperous, maybe, people that have had a good run in the stock market or the gold market or whatever, or people that have a job that pays a lot of money, are fine. But there's a whole lot of other people out there who are struggling. And that's the affordability crisis. And those people all get to vote. And you got to think that a lot of those people voted for Trump and expecting him to do something about it. And it's just gotten worse since he became the president. Not that it's his fault so much for the folks that think that, Trump is God's gift, but it is. And so that's one of the things that I think about. What is Trump going to do between now and the elections in November to try to have the Republicans retain their majority in both houses? And in the simplest language, what he's going to do is he's going to try to get the economy going, create more jobs and that kind of thing. So I would expect more fiscal stimulus as well as more monetary stimulus, and then that comes back to the debasement trade. More fiscal and more monetary stimulus equal, the debasement trade, and so therefore I think it continues as we go into the new year. That would be the way to bet.
The U.S. dollar index fell about 13% in the first half of last year, its worst performance since 2017. Then it went sideways the rest of the year. What are your thoughts on the currency markets?
Yeah, the currency markets, first of all, my thought would be they've been boring as hell the last 6 months or so. And you can see that in the volatility. Vol in the currency markets is probably as low as I can remember it, and it's probably been lower, but, there's like nothing going on. They're just going sideways. And it's interesting that that's happening. I mean, it's always interesting to me. I live and breathe by going, gee, why is the market doing that? That's the way I think. Why is that market doing that while these other markets are doing this? The currency markets have been boring. They've been going sideways. We have, for instance, the Japanese yen. Well, actually, all of the Asian currencies, here's my view, are way lower than what they should be. And they are that way because they all need to compete with each other, and particularly with China, and to gain market share. These are exporting countries, and the mercantilist policy number one, is to have a cheap currency, keep it cheap. It makes it easier for you to export your stuff into markets where the currencies are higher than yours is. So there's that going on. Some of the things probably the one thing in the currency market I'm really focused on is the relationship, or the price relationship, between the Japanese yen and the euro. Now, I'll start this by saying I would be short the European currencies, particularly the euro and the British pound, just on the basis of their energy policies alone, compared to the U.S. dollar. In other words, I would rather own or be a buyer of the U.S. dollar than the euro, simply based on their energy policies. There's other factors, of course, interest rates and positioning and all of that, but there would be that. So I think the euro is probably overpriced relative to the U.S. dollar. And then on the other side, I look at the Japanese yen, and I think like it and all the other Asian currencies are really underpriced. And the Japanese yen, in terms of the euro, has never, ever been cheaper. And I'm thinking, okay, what would cause that trade to turn around? Now, we've got a new prime minister in Japan, but it seems as though the market thinks she's just going to continue to try to stimulate the economy to get it going, which means they want to keep the yen low. They want to keep their interest rates down. So that wouldn't do it. And then maybe it's the other side. Germany, seems to be losing market share on a lot of the manufacturing they're doing to China. I'm inclined to think it's kind of a deflationary trend that we're seeing in the rest of Europe, but of course Germany is just so important. So I think maybe that trade would start happening with the euro falling against the yen as opposed to the yen rallying against the euro. Whatever. Mostly the currencies have been boring. I don't see anything that makes me want to jump the gun and get in ahead of time on any trade, but there's that. For our Canadian listeners, the Canada actually has had a pretty decent run here the last couple of months. People reading my trading desk notes that I publish weekly on my website would see that I've been a buyer of the Canadian dollar. I mean, I'm not been pounding the table with it that it's the buy of the century or anything, but the Canada's done a little better, and that's even happening with crude oil. I don't know, we're down around 5-year lows. So, the market's kind of voting with their feet a bit. Maybe Canada got too oversold. Anyway, Jimmy, you asked me about the currency markets. That's sort of what I think. They've been boring. They'll probably be anything but boring as we go into this year, because that's the way the market works. But right now, I haven't got any really good ideas on the currencies, other than I'm looking at these extremes.
Stock markets around the world rallied in 2025, with many reaching all-time highs. Do you think that trend will continue?
Well, that's probably the way to bet, just because, what else you're going to do? I mean, when I look at the currency market, and particularly if you back it out and you look at a chart, say, going back over the past 15 years since the great financial crisis, and you see this almost a parabolic run to the upside folks that have been in the business a long time, my vintage, you look at that and you say, oh boy, does that ever look overbought. But then, on the other side, the denominator of the trade is the dollar. So just like people have been buying gold and silver particularly, I think, has been the retail favorite, but I think people own stocks as part of the debasement trade. Instead of just keeping cash under a mattress or in a bank account or something, you say, hell, I'm going to buy some of these stocks that are going up so that I can, at least keep my head above water or maybe, get rich, whatever your level of enthusiasm is. So, in that way, the debasement trade, as I said, I think continues. So on that score alone, I guess, the path of least resistance is for the market to go higher. I look at a number of the leading analysts, as they are called, on Wall Street, and everybody is predicting the stock market's going to go higher. Not racing higher, like in the last 3 years, it's been up a double-digit number each of the last 3 years. I think the markets are toning that down a little bit. But on the forward earnings expectations, the analysts are looking at the stock market, call it the S&P 500, earnings to be higher than ever, and the stocks have been trading sort of in lockstep or in advance of strong earnings. So that would say the stock market's going higher. The only thing, I guess, that would be against that is just my intuition looking at it and saying, when something goes on for too long, it has a correction at the very least. So I tell you what, I am starting the new year with not a single, what people would call high conviction trade. I'm just looking at everything and saying, well, I have no idea, but I'll just watch here as I have done for years and years. I watch. And if I see something starting to develop, or I think I see something, then, I'll take a position. But right now, I don't have anything to say to your listeners, like, you really got to do this. This is going to be a great day. Like, it's next door to guaranteed. I'm of the school right now that anything can happen. So I feel kind of dumb and unconnected, so I'll just sit back and wait till I see something that I think is happening and then get involved.
Crude oil prices have been trending lower for the past few years, with WTI briefly trading below $55 in December. Why has that happened, and do you expect the downtrend to continue?
Well, to answer that last part, I can see where it could. I'll tell you what. I just read. I've been a subscriber to Bloomberg for 5 years, and he would. I think first of all, Bloomberg says energy is life. And I really understand it and agree with that. We're consuming more energy all the time. And if you want a better quality of life, wherever you are in the world, and I mean that literally, you need more energy to make a better quality of life. So that will be a underlying demand driver for energy of all forms. But, and here's the but, when I look at crude oil at, call it $55, $60, I mean, we are cheaper than ever in my trading career of 50-some years. Once you factor in, you discount it for inflation. I mean, we were trading $30 crude back in the 80s. And you put a multiple on that. I mean, $30 crude, that's like $120 now, just on a 4-to-1, inflation adjustment. And so we're trading at less than half of that. Why is that? And I'll tell you, I know you talk to Joseph Schachter on your show here frequently. Joseph's been a longtime friend of mine. I go to his conference in Calgary every year, and every year I am blown away by the technology that the energy sector, particularly in Joseph's case, the hydrocarbon folks, the technological advances they have to find oil and to be able to get it and get a higher percentage of it out of the ground than ever. And that is, technology is deflationary, let's say it that way. And it certainly showed up in the crude oil market. I mean, I think, 40 years ago, people were talking about peak oil. Like, we've got about 2 years worth of oil left, and then we're going to have to start rationing this stuff. I'm exaggerating to make the point. But we have got more oil now, and oil, as Bloomberg likes to say, oil is anything that goes to a refinery, so that means crude, that means natural gas, that means natural gas liquids, and they're substitutable for each one another in various forms. We've got more now and more available now than ever, even though the demand is greater. So it has been broadly, there's been more supply coming out of the market than the market is demanding, and, that pushes prices down. So, yeah, crude has been under pressure. I mean, we had a spike of $130 in the spring of 2022 when the Russians invaded Ukraine, and it's trended lower since then. Here we are down to prices that some folks might have thought was unbelievable a few years ago. But let me give you one thought that just really is a head scratcher. We've got crude down here, and it's really cheap, and you look at the energy stocks, and they're not. I tell you what, Exxon-Mobil, I guess the biggest oil company in the world, or maybe Saudi Aramco is, but whatever, in our world, Exxon-Mobil shares closed at the highest ever monthly close in December of 2025. Even with crude oil this cheap, the shares of ExxonMobil, and I'm saying, have basically never been higher. So what's going on? I think the oil patch is and you look at the broad indices, the same thing is happening there. They are not down to what, if you told me 3 years ago that crude oil was going to be 55, where would the oil prices be? I would have thought much lower, and they're not. So anyway, the downtrend I would expect would continue on the basis of there's more supply in the market than what demand is there. But at the same time, markets get going too far one way, and then they'll have a reversal as well.
Before we wrap up the interview, you've often said you make money trading because of risk management, not because you're great at crystal ball gazing. What does it look like in your day-to-day life on the trading desk?
Well, I think in a way I just answered that a few minutes ago. I was saying I don't have any high conviction trades right now. And believe me, I'm spend a lot of time in front of my screens. I subscribe to a lot of services. I swap emails with a lot of people who are traders, active traders. And I just don't have a real high conviction trade here. I kind of feel like anything could happen. The currency market could suddenly get wild. The bond market could, do something. Stock market, where everybody thinks it's going higher, could surprise. I look at some of the ag markets. Soybeans, corn, wheat, cotton. These things are super cheap. Again, on the basis of if you adjust them for inflation, we've never been cheaper in the past 40 years or 50 years of my trading experience. So, maybe something happens in that space. People have been so focused on stocks, and with good reason, and there's certainly aspects of the stock market, but there's other markets out there that are really important as well, and, we'll see. So what that means is, as much as I like to do something, I like to put on a trade and make some money, and I'm willing to live with putting on a trade and losing some money. That's just what happens. But I think right now, what being a good risk manager means is, don't just what is it, the old expression, don't do anything, just stand there or something like that. Sometimes, you just have to wait and say, I don't see anything I really want to do right now, but I know how I can wrap this up. My old friend Peter Appleby, who was one of the veteran commodity traders in Vancouver. If you were in the commodity trading business, you knew Peter, and he passed away just a few months ago. God bless him. Peter used to have a beautiful expression. He'd say, there's a rumor going around that the markets are going to be open again next week. And I think that's a good thing to keep in mind. Just don't get so excited that you feel like you have to do something. Sometimes the best thing, just wait. Wait for the kind of the market to set up in a way that makes sense to you, and then, take a position. Don't get in over your head, but, that's what it means to me in my day-to-day life, Jimmy.
Victor, thank you so much for chatting with us.
Always a pleasure to talk with you, Jim. Thank you kindly for having me on.
My guest has been Victor Adair, recently retired from nearly 50 years in the brokerage business, but still very active in the markets. His website, victoradair.ca. Coming up, Martin Straith, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money and Happy New Year.
Oh, and Happy New Year to you, Jim, and to all your listeners.
You've been publishing the Trend Letter for over 25 years now and have been an investor for nearly 50. With all that experience, what lessons have you learned and what advice could you give our listeners going into this new year?
Yeah, well, you're making me feel pretty old, Jim. Yeah. Well, like everybody else, I don't have a crystal ball, so, no one does. So I just say I've been doing this for almost 50 years. And, I think I've probably made about every possible mistake you could make as an investor. So fortunately, most of those mistakes came pretty early, and they became, basically my greatest lessons learned. So, we've all got opinions about the market. The real danger begins when you assume that your opinion is right and the market is wrong. The market's never wrong. It's simply reflecting what the current reality is. So I think it's important to be pragmatic in how you approach the markets. I trade what is happening in the markets, not what I think should happen. I let the market tell me the story rather than try to force my opinions onto it. That discipline, it sounds very simple, but it's one of the hardest things for investors to learn. Experience doesn't mean you're going to be right all the time. It means you're going to learn how to manage being wrong. And I think, successful investing, it's not about predictions. It's about the probability and risk management. And the reality is you are going to have losses. So the goal isn't to avoid losses entirely. That would be nice, but it's not going to happen. But you want to be able to keep those losses small and relatively pain-free. Markets change constantly, and strategies need to adapt to that. So emotions, that's the silent killer of returns. Fear and greed move markets way more than fundamentals. So, the key to know it is patience is a skill. It's not a personality trait. So it can be learned. And if you miss a trade, that's okay. Think of it like a train. When a train leaves a station, you don't try and chase it down the tracks. There's always another one coming. So if you stay flexible, manage your risk, and keep learning, the market will always offer new opportunities. So there, Jim, there's a few of the many lessons I've learned in the markets over the years.
Well, even though you don't have a crystal ball, you have been warning of a big tech Magnificent 7 correction. What are you concerned about?
Well, first of all, you have to understand that I am totally on board that AI is not only happening, that it's going to be, and it is becoming a game changer, much like the internet. And other than the extreme valuations for some of these companies, one of my main concerns relates more to the underlying financial structure of how many of these financial deals are happening. So what I'm talking about circular financing. And I posted an article, I think it was a week or two ago, and you can, your audience can get at it. Just go to thetrendletter.com, go to updates, and you'll see we post lots of articles up there. They're all free for anybody to read, so they can catch up on that and get a little bit more detail for it. But circular financing happens when the same group of tech giants effectively fund each other's growth. So we've got Oracle builds data centers for OpenAI. OpenAI relies on NVIDIA chips. Microsoft and Meta help fund OpenAI. So money moves around the same circle, creating the appearance of a massive demand, even though little outside cash is entering the system. So on paper, the revenues look strong. In reality, the risk is quietly building. And if one company stumbles, the entire loop could break. So this type of financing creates, a synthetic demand. If the end user, so that's, you and I, the public or businesses, don't eventually, pay enough for these AI services to cover these costs, that circle is just moving the same pool of capital around until it runs out. So Oracle's a perfect example. So more than half of its cloud backlog, so that's about $300 billion, is tied directly to OpenAI. So that story, when it came out, that pushed Oracle shares up about 36% earlier in the year. And then reality hit. Then we started finding out the numbers. So capital spending for Oracle surged, $12 billion per quarter. The total debt climbed, above $100 billion. Their revenue missed expectations. Their guidance was cut. So then, when all that came out, then the stock fell about 40%, wiping out about, about $360 billion in market valuation. And then Moody's, the rating agency, said Oracle had the highest exposure to OpenAI, and it had the weakest credit metrics among the peers. So then we had delays tied to OpenAI projects that just added to the pressure. And now we got to look at OpenAI. So it sits at the very heart of this whole ecosystem. It committed, about $300 billion to Oracle infrastructure, but its finances are stretched. So OpenAI, the projected cash burn by 2029 is $115 billion. Their annual losses are expected to reach $14 billion this year. Their compute and data center costs alone are projected to be near $100 billion. So you've got all of that, and then their expected revenue this year is only $30 billion. So then you look at free cash flow, and free cash flow is basically the cash that a company has left over after it pays for its regular business bills and it invests the assets to keep the business going and growing. Well, look at these numbers. So Q1 2025, so this is free cash flow growth over the previous year. So the first quarter of this year, it was up 19%. Second quarter, down 6%. Third quarter, down 53%. Fourth quarter projected to be down, and these are their numbers, 103%. Q1 2026, their numbers, down 152%. Second quarter, down 238%. So, those are pretty ugly numbers. Now, I checked with Perplexity and Gemini AI, and, I always check these AI tools. If one of them gives you some numbers, I always run it by the other ones to make sure that those numbers are realistic. Top 10 stocks in the S&P 500 represent about 42% of the total market capitalization. In the dot-com peak in 2000, the top 10 stocks accounts about 26% of the total market. So today it's about 16% over the highest one on record prior. So what am I concerned about? Okay, you've got investors are funding OpenAI. OpenAI has committed $300 billion to Oracle's infrastructure. Oracle borrows heavily. They got $100 billion in debt to build these data centers. Oracle's valuation hinges on OpenAI paying up, like paying those bills, and requiring OpenAI to raise more cash. So the question is, what if OpenAI's cash burn, which is $115 billion projected in 2029, outpaces its revenue, which it's totally doing. Its revenue for this year is $30 billion. So, and if fundraising stalls, what if they underutilize the capacity, and that would saddle Oracle with debt, idle assets, revenue shortfalls, and that exposes the retail investor to a bubble. So to me, when you see these big movers of the markets doing this circular financing, the risk is huge. Now, could they still survive all this? Of course they could. But the risk is high, and that's why we're keeping an eye on it for sure. It doesn't mean you need to dump all these big tech stocks today, but you just need to be aware of these risks.
Given those concerns, do you think the top is in for these AI hyperscalers?
Well, that's the tricky part. You know, we're technical analysts, meaning that we let the market tell us if and when a top is in. You know, stock market tops, they're challenging to identify. They're very hard to know that this was actually a top, especially if you look at recent corrections, you know, especially since COVID. You know, when we get these corrections, they're steep and they're quick, and then we get these V recoveries because, you know, the model is, you know, buy the dip, and that's been happening for the last 5 years. Now, back in 2000, when we had the dot-com crash, the NASDAQ topped out, but it was not, you know, there was no real catalyst for it. It just basically collapsed under its own weight. You know, the valuations just got so extreme. And when stocks are priced to perfection, which is really what they are right now, it doesn't take a whole lot to turn things down. You know, from 2000 to 2002, the NASDAQ lost 75% of its value, but it did not go straight down. You know, to be short a market like that, you really have to be on your toes. You know, there were over a dozen rallies within that 75% decline, and most of those rallies were over 23% or more. Some of them were over 40%. So you had this, you know, this longer term, you know, 2-year decline in the market, but within that you had all of these rallies, and you know, like 40%. That's a big rally. So trying to pick a top is challenging. You have to have a real conviction to be short to ride out all of those rallies. Now, what do we watch? We watch the charts. A couple things that have our attention right now. If we look at the semiconductor ETF, we've had a recent double top here. And then if you look at NVIDIA, it hasn't even been that strong. It has not been able to even retest its October high. And you have to remember these numbers. So at its high, when it got up to $212, NVIDIA was trading at 38 times sales. That means investors were paying $38 for every $1 in sale. Now, obviously, NVIDIA has been reporting some huge sales. I think $200 billion was their last earnings report. But even that, and with the price now down, there's still price to sales is still at 28 times. So again, $28 you're paying for every dollar of sales. So it's really difficult for these large established companies to maintain such huge margins. And to put all that into perspective, you know, the average S&P 500 stock trades at 2.5 times sales. So $2.50 for every $1 in sales. And NVIDIA is selling at $28 per $1 of sale. So as investors, again, you need to be alert here. NVIDIA and the Mag 7 were the big market leaders all the way up. They could be the big market leaders all the way down. So what do? Is we watch the trend. If we see a trend broken, then we alert our readers and we make the necessary changes to the portfolio.
If we do see a big correction led by the Magnificent Seven, where would you be looking to lead your subscribers?
Yeah, well, that's the real challenge here now is, you know, those Magnificent Seven are such a huge chunk of the market. And if they do go down, well, you know, they're going to take part of the market down with it. So the question is, can we see a major sell-off in big tech and then have a rotation into these other sectors, the ones that have been very quiet and unloved for a long time? You know, we've been recommending some of these other sectors already to our subscribers. We got into copper and rare earths, for example. Some other areas we're interested in, we like aluminum, nickel, base metals. But you have to remember that the Mag 7 stocks represent, again, about 40% of the market cap of the total S&P 500. So if we did see a mass exodus of the Mag 7, that's a lot of money coming out of those stocks. And it could be a huge boost to some of these smaller sectors. You know, all you have to do is think back a year ago. You know, a year ago today, think about the gold miners last year. You know, the gold miner ETF so that's that JDX, that was trading at $34 last January. Well, today it's almost 90. So that's a great example how when the market turns and decides it now likes a forgotten sector, it can be an incredibly powerful move. So we've been adding some of these other sectors, and we're going to continue to do so. You know, it's funny, Jim. I mean, in the newsletter business, when you get flack over a suggestion or recommendation, it typically means it's a pretty good idea. So back in July, after Trump had been threatening tariffs on copper, you know, we added a copper play. Now, we got all kinds of flack on that. Like, what are we talking about? This is crazy. Trump's going to, you know, do all these tariffs. And we said that the tariffs can't be. He's not going to do it that way. And sure enough, a couple of weeks later, he removed the tariffs, and now our stock's up 55% in 6 months. The reality with stocks is that being opposite view of the masses is generally a good place to be. I mean, if everybody agrees with you, then it's already in the price. So while we're starting to add other sectors, we need to understand that, you know, if we do get a big hit in the Mag 7, again, it's such a big weight of the S&P 500, the whole index will probably take a hit, at least initially.
Gold and especially silver have been front and center lately. What's your take on gold and silver?
Well, yeah. Long term, we like them both, and as we have been for a while now. Now, of the two, gold is certainly the least volatile. It's kind of that, you know, kind of sleep at night metal. Now, gold sold off earlier this week, primarily after the CME exchange raised their margins for precious metal futures, and they did that twice in, about 3 or 4 days. So that forced leveraged traders who didn't have enough cash in their account to sell some or all of their gold just to raise that cash. Also, you know, we had profit taking. I mean, gold's been very overbought technically. We had institutional investment funds rebalancing their portfolios for year end. And again, the key for gold prices is that while it hit new highs recently, the momentum has really slowed down here. So that often suggests the price might be getting a bit tired here. So we should expect at least a dip and, you know, potentially a bigger correction coming soon. But we would see that, you know, as really a healthy pause rather than any trend reversal. You know, you've got to remember, you got the potential Fed cut, especially if Trump gets his new chair in there. He wants a real dovish guy in there. You got central bank buying, you got the geopolitical risk, you got the erosion of purchasing power of all fiat currencies. So, you know, it's January to late February is typically a very good seasonal time for gold. Just looking at it right now, it's trading at about 43.29, so down about $11 right now. Initial support would be 41.75, which is the 50-day mover average. If that fails, there's very strong support at about 3,900. And on the upside, you got resistance at about 4,400. And then if we can break through that level, that should take another run at the all-time high, about 45.50. Now, with silver, my God, what a month we had in December there. You know, after it broke through its previous high at 50 in mid-October, you know, it just traded sideways for about 6 weeks. And then, you know, once we hit December, it took off. So it went from $52 at the beginning of December to a high at $83.62. I mean, that's a gain of 60% in a month. You know, and then this week, it basically crashed from that 83.62. It went all the way down about 71.25 on Wednesday. So that was a drop of about 15% in a couple days. Now, that drop again was heavily influenced by that CME exchange raising, you know, margins for precious metal requirements. You know, and investors, we need to understand that with gold and silver, there's really two markets here. You've got the paper market, which is consisting of, you know, the future contracts, and those are settled in cash. And then you have the physical market, and that's the actual silver bars and coins. So the paper market is much larger than the physical market, especially in silver. You know, the silver paper market is up to about 300 times larger than the physical market. Now, that all works fine until too many investors want to own the actual metal itself. When that happens, prices get really volatile because there's simply not enough physical silver to meet the demand. Now, given that narrative, I mean, you would think that the price of silver should have shot up, not down. But again, you have to remember those margin hikes played a big role. You know, the CME simply raised those cash requirements, and they did it twice in like 5 days. So that forced selling. Traders, again, the ones that were unable to, put more cash up were forced to sell immediately, and that pushed the prices from that, mid-80s down to about 70. So in the bigger picture, we're still very bullish for silver. One thing you got to remember is, we're into January now, and on January 1st, China started restricting silver exports. They're calling it now strategic mineral. So now only approved firms are allowed to ship it abroad. We're also seeing some U.S. tech companies. They're now reportedly considering direct involvement in silver mines. So they're buying shares in silver mines to secure supply. So this silver won't even get onto market. We could see silver pull back further, potentially maybe to the $60 range in the next couple of weeks. And again, that's especially if the CME exchange again raises those margin requirements. But big picture, we're very bullish. The market, it's been in a supply deficit for 5 years. Demand is being met by draining existing stockpiles, not new mining. And you have to remember, growth is limited. Most silver is mined as a byproduct of other metals. So higher prices don't quickly lead to more supply. And for mining companies, I mean, it costs them about $15 to get silver out of the ground. So at $73 to $80, they're making a killing here. So we're also seeing refiners. They're getting flooded with people now selling their old silver jewelry and silverware, all their forks and spoons. Refiners are actually now offering lower prices because they can't even keep up with all the inventory they're getting from all of these silverware and jewelry. So they just got too much to process. The market has been in it's been a real frenzy. If the CME does another margin rise, we could see another pullback to, like I said, to maybe that $60 level. But if we do, that would be a blessing especially if you haven't got any silver. Again, today it's trading about 72, 75. I definitely see silver hitting $100 this year. And the way it's been moving, who knows, it could be in the next couple of weeks or months.
What do you see ahead for the U.S. and Canadian dollars?
Well, with currencies, I always say this, it's all connected, and it's all driven by the U.S. dollar. So if the U.S. dollar is up, other currencies are down. If the U.S. dollar is declining, other currencies are rising. So if you look back a year ago, going back to as the U.S. election was happening and the ramp up to it, the U.S. dollar was in a huge bull rally up until January of last year. Everybody was bullish the U.S. dollar, but then in January it started to sell off, and it did. It sold off until July, and since July it's been trying to trend higher, but it's been struggling. And one of the main reasons for the U.S. dollar strength a year ago, and even since July, it's been this inflow of foreign capital to jump into that Mag 7 big tech bull market. So when we ask, well, what happens if, we were talking earlier about what if the AI euphoria is in a bubble and the stocks start to turn down? Well, that could send a lot of that foreign capital back home, and that would hurt the U.S. dollar. Also, we've got the expectation that Trump's going to put in a much more dovish Fed chair to replace Powell. That could result in much lower interest rates. That would reduce the yield advantage that U.S. bonds have over foreign bonds. And if that happens, you could see the U.S. dollar turn lower. And again, Trump wants a lower dollar. And the key reason he wants a lower dollar is he wants lower interest rates, because lower interest rates, he wants to keep running up large deficits. But the problem with running up large deficits is you got to pay interest on those deficits. And, the more you keep running up, and if the interest rates are higher, well, that's just more of that budget has to go to servicing the debt. The U.S. is already paying over $1 trillion each year just to pay interest on their debt. So Trump wants a weaker dollar. He wants also to boost exports. So I think, if his new chair does what Trump wants, And we know that Trump wants Fed rates down to 1%. Well, that would really hit the U.S. Dollar. Now, the Canadian, it's been on a nice roll here. It's up about 73 cents now. We had a series of aggressive rate cuts early in 2025. But since then, since about the last couple of months, the Bank of Canada has basically hit the brakes on rate cuts. Now, you've got the Fed still expecting to cut rates in 2026. Well, then again, that's going to narrow that interest rate differential. So that gap between the U.S. and Canadian rates, if it gets smaller and smaller, well, then that should support a stronger Canadian dollar. Also, you've got to understand energy. Even though the price of oil has been weak, with the expansion of the Trans-Canada Pipeline, that's allowed Canadian producers to ship more oil to other countries than the U.S., especially to Asia. And so that's narrowed the gap of the Western Canadian select price versus the WTI price. And that means that Canadian producers are now pocketing a lot more money than they have previously. You've also got, reduced trade tension with the U.S. That's helped balance trade with Canada. And of course, you got this, the big surge in precious metals. That's given the loonie a boost. So again, as I say, it's all connected, heavily driven what happens with the U.S. dollar. If the Fed cuts rates and all these other central banks are holding steady, then you're probably going to see the U.S. dollar pull back, and we're going to see the Canadian, the euro, the yen, etc., start to rise, at least in the short term.
The last few times you've been on, you called for oil to drop below $60, which it's done. Where do you see oil going this year?
Yeah, the oil story is pretty interesting, and it's really, it's kind of a tale of two worlds here, because the price of oil, as you just said, it's been around, it's touched around $55. And so it's been low, yet the business of oil is booming. The price of oil, we've been hitting, we hit the low was $54.90 in mid-December. That 55 support level has been hit 4 times now. So it first hit it in April, then again in May, then in October, and then a couple of weeks ago. And despite the U.S. curtailing Venezuela oil exports, which are down about 450,000 barrels per day from December to November, there's a glut of oil. And so despite these low prices, oil companies are doing very well. I mean, Exxon just hit another all-time high. So while we're getting into the winter cold season, January typically sees oil move sideways. So it's not until you get into the spring driving season that you start to see oil prices really rise. So again, we got peace talks with Russia and Ukraine. So that could cause some volatility. If the markets believe peace is going to happen, then that opens the door for more Russian oil coming into the stream. And that just adds to the oversupply story. Now, if peace talks break off, well, we could see a jump in oil. But again, all of that's kind of short-term volatility. In the bigger picture, we see much higher oil prices starting later in 2026, likely in the $70 to $80 range. One of the things that most people forget is how important oil is for so many of the products we use every day. So it's not just about gasoline for cars. Oil is a key component in clothing, medical supplies, asphalt for roads, whether it's an EV car driving on it or a gas car, tires for those vehicles. You've got beauty products, you got electronics, so computers, your smartphone, eyeglasses, sports equipment, shoes, you name it. I mean, oil is just so much a part of everything we use. And you got projections from the International Energy Agency. Now, they're saying that 80 to 90% of future oil demand growth is going to come from emerging economies, where they're saying over 4 billion people currently have very limited access to energy. Well, you can just imagine as that's starting to change, those emerging countries, they want all the kind of things we've got. Now, emerging Asia, for example, is the fastest growing region for oil demand overall. And the big increases are for industry and transportation demand. So as investors, we need to remember that oil is much more than gasoline we use to fuel our vehicles. We're seeing that electrification, everything happening. It will reduce gasoline demand in developed countries, but we should not forget that all these other products that oil is a component of, there's things that people in these emerging countries need and they want. And, you have to remember that the cure for low oil prices is low oil prices. So, as prices rise for companies, producers, that increases their cash flow. The heads of those companies go, well, they like that. So they say, well, let's reinvest some more money and produce more of this at these higher prices. And so what eventually happens is supply starts to outpace demand, which is where we are right now. And when that happens, prices decline. But then those same companies that raised, production during the rise in price, they're starting to go look at, well, wait a minute, we're not making as much money anymore, so let's not invest so much money in production. So they start to reduce. So that forces, shutdowns and cuts. So what happens there? Well, now the supply isn't keeping up with demand and prices start to rise again. So I'm looking for oil to retest, that $55 short term again. But in the second half of 2026, I think we're going to see $70 to $80 oil.
You've been very bullish on natural gas for the long term. It's very volatile. Why are you so bullish?
Yeah, if you want to invest in natural gas, which is a good investment, but you have to have a thick skin and a strong heart because it is extremely volatile. I mean, it's heavily driven by weather. And it's picked up the nickname over the years of the Widowmaker because of the extreme price volatility. The ability for it to wipe out even the most sophisticated investors. So you need to be warned. But a big reason I like it is because of the insatiable need for new power, especially in the U.S., but again, around the world. And it's being driven by this AI data center needs. So the U.S. electric grid is hitting a fundamental capacity wall right now, and it's being driven by these data center power demands. So here's some numbers from the International Energy Agency. The U.S. is now projected to need 134 gigawatts of power for data centers by 2030. That's over double the current use of 61.8 gigawatts. Now, if we're talking about what we're talking about really is the first meaningful expansion of electricity consumption in generations here. So in the U.S., Virginia is the highest data center market in the U.S. But to get grid connection, so to actually get put onto the grid, the wait times in Virginia alone are 7 years, which explains why these data center developers are starting to bypass the grid entirely and they're building their own generation. And the key for us as investors is natural gas has become the default answer for these data warehouses because it's the only fuel that scales fast enough to meet the immediate demand. So data centers right now, again, according to the International Energy, they're driving 2 billion cubic feet per day of new natural gas demand by 2030. So these large data center projects are building gas plants on site as primary power, not as backup. So natural gas provides, continuous base load power. It ramps quickly. It's most critical to build in 10 to 24 months versus the 7 years of the, waiting for a grid connection. Now, really long term, we're very bullish on nuclear as well, but, because it presents, a great carbon-free solution. But construction timelines for nuclear, there's 7 to 10 years minimum, and often stretching long past that due to regulatory approval, site preparation, the complexity of building gigawatt-scale plants from the ground up. So we like nat gas over the next few years. Yes, it's volatile, but I think the payoff is going to be worth the price fluctuations.
Can you review what sectors you like for 2026?
Yeah, well, as we talked about, so, again, I talked about gold miners in the last year. I still think they're going to do very well. As I mentioned, the GTX went from $34 to, $90 currently. I think we could certainly see some of that same kind of movement in some of these other sectors. like if we get a rotation out of big tech, again, that means some of these unloved sectors could do really well. So again, I like precious metals. I like base metals. So, copper, aluminum, nickel, energy. I mean, we're talking oil. We just talked about natural gas. I also think staples, the things we just recommended a company a week ago, a company that pays a really nice dividend, and it's kind of stuff that people have to have no matter what, whether we go into a recession or there's huge inflation. These are things that people need to have and they use every day. And even utilities, I think, will do well. And when we're talking energy, I think even solar is going to do well with all the new demand for electricity. Solar is, it's not consistent, it's not base load, but it can certainly help at peak times. So I think 2026 is going to be a very interesting year for investors.
Can you remind our listeners about each of your services and about the Boxing Week specials that you had on and are willing to open up again?
Well, we have 6 services now. 3 are paid services and 3 are free. Of the paid services, we got the Trend Letter. So this is our 25th year. We're starting now. Publishes weekly. It's good for long-term investors wanting to understand what's driving these markets. So the special, we have a Boxing Day special which just ended. So what we've agreed with your group is that we will extend that out so your listeners can get a chance at those prices. So the prices are 33 to 57% off. So the Trend Letter, instead of $600, it would be $400. Again, it covers all sectors: equities, currencies, precious metals, commodities, bonds. Then we have the Trend Technical Trader online service, updates every Monday, Wednesday, Friday. Again, for both active and long-term investors. It was started as a hedging service, which it still does do that, but it also covers long positions in equities, precious metals, commodities, and it includes our proprietary gold technical indicator. So its regular price is $650 a year. Right now it'll be on for $400. And then the third one is Trend Disruptors. So that's for speculators with risk capital available. Invest in disruptive ideas, AI, virtual augmented reality, 5G, cloud, Internet of Things. So $600 a year regular, so now it's only $400. Of the 3 free services, we have our DeFi Digest. So that reviews the developments in the decentralized finance sector, a very speculative sector, but we see that longer term that's going to be, I think it's going to be some incredible gains there. We have Market Pulse. So that's a market recap where we will typically send out information where we see key market moves. It might be daily or weekly or whatever, depending on what's going on in the market. We just obviously been publishing a couple of recent ones on AI and a couple on silver as well. Headlines is our other one, so that's a free daily service. What we do there is we go out to look at the market every morning, check the headlines, and then what we do is we send the headlines that we think investors need to be aware of. And then the investors can simply read the headline, and if they want to get the details of that headline, they just click on the link and they can read the article. So for anybody who wants to get more information, they can just email us at info@thetrendletter.com. If you want to get in on those specials, just go to our homepage, so thetrendletter.com. That's all one word, by the way, thetrendletter.com. And you'll see a big red Boxing Day special there. Also, Jim, just to let your listeners know, hopefully we'll see some of them. We'll be at the World Outlet Conference, the Money Talks Outlet Conference this year. I think this is about our 6th year going there. Last year, we recommended 9 products or 9 stocks. Here we are today, so we're just about 10, almost 11 months into that. Of those 9 stocks, every one of them is a gain. The lowest gain was, 45%, right up to 170%. The average for those 9 stocks is 88.87%. So if you get a chance to come to the conference, we'd love to meet your listeners and talk stocks.
Always fun chatting with you, Martin. And can you remind us again how people can get a hold of you and subscribe?
Yeah, so just, you can email us at info@thetrendletter.com, or just go, if you want to get the specials, just go to thetrendletter.com and click on the link there.
Thanks again, Martin.
My pleasure, Jim, and Happy New Year to all of your listeners.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, Victor Adair, and Martin Straith. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.